How you doing, everybody? Nathan Brooks with Sutton Group Select Realty. It is March 26th, and I am delighted to have with me today David Yuzpe, President with Real Mortgage Associates. And David, thank you so much for joining me. I've been quite excited to have you because you are one of the most trusted advisors that I work with and introduce my clients to when they're seeking mortgage advice when it comes to buying and selling real estate. So can you hear me okay on your end there, David?
Yeah, I can hear you perfect. And thank you for having me, Nathan. I'm grateful for the opportunity to talk to you and to your clients as well.
Fantastic. I'm excited on this because, as we all know, we read the news, we hear it, we're being tossed information left and right every single day, and there's an awful lot of information being thrown around as it pertains to mortgages, interest rates, and how it impacts those who are currently in a buy and sell process. We all know that with COVID-19, it's impacting everybody in many, many ways. It's what was once the old economy is, I think, we are actually going through a shift to a new economy and how we work within that new economy. For us today, if you don't mind, David, why don't we just start nice and easy, high level?
Sure.
From your business perspective, I know you do an awful lot of work remotely already. How does the current landscape with COVID-19 interacting with your clientele, has that impacted you in any way, shape, or form?
Well, it certainly impacted me, Nathan. I mean, I've been doing this for 26 years, and for the most part, a lot of the success that we've built has been on that personal touch, meeting with our clients and sitting with our clients, and we're now forced to do things remotely, whether it's by statute or by just caring about people enough that we are going through our self-quarantine process. And also the lenders, we've always worked remotely. So there's been a bit of a paradigm shift there, but what I do is I keep promising my clients, I said, listen, this is going to end, and at some point when this is over, we will get together and we will have a cup of coffee together, because it's important to me that we have the ability to shake hands and to look at each other and say, thank you for allowing me the privilege to work for you in person.
Okay. So I know that from my side, I am able to actually facilitate trade in real estate with online programs such as electronic signature. Are you allowed to leverage electronic signature from the mortgage side, David, or do you still have to have hard copies, or has that changed at all?
Great question, Nate. There are 95% of all our lenders allow electronic signatures. For example, and I'll use Scotiabank as an example, where we can use electronic signatures. They require what they call wet ink on the pre-authorized debit forms for the payments. But that's as simple as just, we'll scan it to a PDF, email it, and as long as our client has access to a printer, they can print it, sign it, and send it back to do that. There are still a couple of banks that do not accept electronic signatures, and we've just stopped using them. We're trying to facilitate things for our clients, and by saying, sorry, your bank does not allow electronic signing at this time, and have not made that change due to COVID-19, then we're just kind of shuffling them out of the mix right now. We have 35 different lenders, and if one bank says, no, we're not going to play ball, well, there's lots of others that will play ball.
And if they're just not a viable option, they're simply not a viable option at this time.
Exactly.
Yeah, that's one of the benefits to being in your position as a broker. You have an array of options at your disposal, don't you?
That's correct. We have 35 different lenders. I mean, and certainly the mainstream banks are our business partners. Sometimes in some cases they lend direct. In other cases they finance the mortgage banks that are doing it. So all lenders participate in one way or another. It's just sometimes it's behind the scenes, and sometimes their logo is on the approval.
Okay. Let me shift over here slightly, David. It sounds as though this has impacted your business subtly. If anything, it's probably impacted from a volume perspective, meaning I have no doubt you're probably like me. You're having to have more conversations with our clients. People are asking more questions. Things are just simply taking longer. And we're going to get to that speed portion in a moment. But let's just talk about things, from a day-to-day basis. I've scaled my business back dramatically. I'm spending more time qualifying my clients in terms of their wants and needs, really trying to minimize the exposure that I have when client facing. Is this something that we really need to be doing right now? We all have our own social responsibilities, but at the same time, you've got a handful of folders. I've got a handful of folders where our consumers were already committed to the process partway through this COVID scenario. So my question for you is, if somebody does call you and say, Nate, we've already sold our house, as you know, let's talk about the approval on the purchase. From an approval standpoint, David, are you noticing any differences with the lenders? Is it easier, harder, or the same?
In terms of, it's no more difficult to obtain an approval, Nathan, but what I do is I make sure that I'm asking all the right questions. So if there is something that needs to be addressed up front, I'm addressing it. I'll give you specifically, with respect to the number of people that are laid off either permanently or temporarily. These are questions that we're asking. No bank wants to see their customers, their future customers, homeless, nowhere to go. So each scenario is handled on a case-by-case basis. I have not had any so far, even though I do have clients that have been laid off midstream. I have not had the bank pull any approvals or refuse to do a deal. While we were talking, I just saw in the bottom right-hand corner of my screen, an approval came through for a gentleman that is currently laid off, but he is deemed an essential service. It's supply chain management, drives a truck, but the plant that they're moving parts for is just closed for 2 weeks. So they said, hey, as long as he's back to work prior to the closing of the deal, no problem, you have a deal.
Okay, comforting. So it's almost, all systems go. Obviously, it's case by case, but for the most part, that hasn't impacted things all that. I have no doubt that people, and industry specific, if you're somebody maybe within the food and beverage industry, as an example, where a portion of your annual revenue is tips. It's not salary, it's not hourly. You're not even a contract worker, but it's a variable income. Does that make things a little bit more challenging?
In my case, it doesn't, because I don't use too much of the tip income actually to qualify, because that is such a variable. If you have somebody working at a high-end restaurant where they're making, $100 to $200 a night in tips, it's very different from somebody that works equally as hard, but in a maybe a less expensive place, or a place where the tips mean far less. I try to work off of basically the hourly wage and maybe add 10% for tips. That way it keeps it on a level playing field for them, and they don't have to worry. And it also means that income is easily replaceable. So if somebody's working at a beautiful lunch counter place downtown, knowing that place might not survive, but they can go to another place similar, like a Malibu or something like that, that's going to have the longevity. It's easily replaceable income. The lender is going to look at it that way, and our client is going to be sufficiently taken care of. I'm just being a little bit more cautious myself to make sure that we don't have any issues at all. I call it the no surprises rule, Nate.
And that's one thing I love. I think you and I are in the same mindset. Information is extremely important, and managing expectations is extremely important. The last thing we want to do is create false hope, only to create a surprise during the 11th hour, because we all know, in that final week when everyone is planning for moving day, this is the last thing we want to have pop up and flare. So
correct.
Creating any of those final distractions. So, so from an approval standpoint, or sorry, let me fast track if you don't mind. If we've got a pending deal, maybe there's something set to close next week as an example. Are you having any lenders call back to you? Are you hearing anything about delays? How is this impacting maybe the computer systems or anything along those lines?
Actually, have not had too many of that. Anything that's closing within the next week, at least in our case, the files have been completed already. They're long done, and they're well into the funding process. The only exceptions to that are some of our clients the money is coming from offshore. They're clamping down on a little bit and making sure that we're meeting our times for how long money has to vest into an account or something along that line. I think anything that's kind of 3, 4, 8 weeks out, those are easier to address. That we're just making sure, my partners and I are making sure that we're getting our files completed. If anything's coming up, we're having the conversations, any changes, because then we'll know how to address them again, so there's no surprises, and to make sure these people are going to have their homes that they've committed to.
Excellent. Are you noticing any differences in terms of when you're inputting the deals and the software behind the scenes?
Well, thank you for asking.
Was that
We
a
were
leading
actually
question?
shut down. We were actually shut down for 5 days. There was a breach to our system. Now, it was not a data breach; it was a security breach. Nothing was lost, but they had to pull it offline, and it came back at after 5 days. A lot of it was the weekend, but that meant 20,000 mortgage brokers across Canada didn't have any access to a system. They said it was going to be back up. They figured on Tuesday, so actually started working Tuesday at 2:30 in the morning to make sure that I got all my work done before the system got inundated with people and it collapsed. Fortunately, it didn't collapse. The only thing that happened is I collapsed. I was so tired after working for about 16 hours straight, but everything worked out well and my clients were well taken care of, and their approvals were the first ones to come back through the system.
Interesting. Okay, so that was one of the workaround strategies that you implemented just on your own, try to avoid those peak hours within the system itself.
True, and I will, if I can just note. So most of the banks is their own personal security to COVID-19. They have most of their, or as many people as they can, working from outside. So they're working from home. You have to understand the bank systems were not set up to have thousands of people working remotely. They have certain positions where these people do work remotely. They talk about not having enough bandwidth or enough lines to get in. So, I mean, I know that Scotia and TD over the last couple of weeks, CIBC, I think, not through any fault of their own, have had some downtime where systems have crashed and they've come back up relatively quickly. But that's kind of the only slowdown. Where my business has always been this way. We have lots of bandwidth and we can take care of anybody that needs to be taken care of. That's the only real slowdown, though, is because just capacity. Is it server capacity? Maybe that's the kind of the term I'm looking for. But
That's fair. And I would agree with you. I think everybody's experiencing that, not just within the lending industry, the banking industry as well, but all industries across the board. Nobody's really set up for this, but it'll be an interesting opportunity for us to create more exposure and maybe even more flexibility for those businesses going forward. But for here right now, I have no doubt that people are naturally working longer hours. They're being consumed. They're being pulled in every different direction, and patience is key. And it sounds as though you found some opportunities to work around that. One thing I did want to ask you, and because this is also a popular topic when we talk about mortgages, we all saw the federal government with a handful of announcements last week, one of them touching on mortgage deferral programs. From a very high level on that, are you getting asked about that, from our clients? And if so, can you offer any insight from your perspective?
Yeah, we're getting asked consistently. So here's the misconception is that everybody can automatically just defer their mortgage payments. That is not the case. If you're gainfully employed, there is still an expectation that you have to make your mortgage payments. If you become laid off, or if there's an extenuating circumstance, if something has happened, then you can apply to have your payments deferred. It is not an automatic. You have to apply. Now, the banks are being absolutely inundated to the point where they can't even take phone calls most of the time. So here's my suggestion. Figure out who your lender is. Most of your lenders have an online portal or an online capability. Communicate through email. If you want to grab a sandwich and a cup of coffee and maybe be prepared to be on hold for 3 or 4 hours, you can try phoning. But we're told that the best way to do it is to go direct to the lender. We as brokers and your mortgage sales force with the different institutions, we have no ability to make anything happen faster than anybody else. It's a different department of the bank, and there's systems that none of us have access to. Reach out online, tell them what you're looking to do, tell them that you would like to apply to have your payments deferred, and then they'll get back to you. Let the process move.
Okay. That's
But
helpful.
every bank has agreed to participate in the program, so thank you to them for all doing that. Nobody has said no.
And is it case by case in terms of the lender and maybe some of the rules or regulations that they would have around that? Is there additional fees that that we're hearing about? I don't want to get too caught up in the weeds on that by any means here, David, but
from our understanding, Nate, and so and I'm going to stress from our understanding, all they're doing is if the number of months that you defer, they're going to tack on to the end of the mortgage. Most most institutions that have what's called a skip a payment option have a small fee of $90 to $120. I believe that fee has been waived, but they're not just going to blanket 6 months either. Some banks are a month or some are 2 months at a time, and you have to reapply to a maximum of 6. And that's why I said, with 35 different lenders that we deal with, every single one is different. That's why I implore you, please reach out directly to your lender. You can certainly call us for, certain things that we may be able to help you with. But in terms of the deferral itself, it is going to be it is client specific and lender specific.
Okay. Most helpful. Thank you.
You're
Now,
welcome.
we can't have a conversation with a mortgage guy and not touch on rates.
Okay.
Everybody that I'm hearing, oh my gosh, rates are changing, and so on. One thing that you taught me, years ago when we started working together, and I was very happy about this, because you just told me straight up, Nate, don't try to be a mortgage guy. I'm the mortgage guy. You focus on real estate, become a specialist on the industry and buying and selling in real estate.
Tell me I said it in a much nicer way, Nathan.
Well, I am summarizing, of course, but I love it, because we all have our areas of specialty, and there is no way that I would ever want to position myself as a mortgage specialist. Apart from, hey, any mortgage related questions, let's talk to a mortgage person. And I can maybe talk high level on ratios and so on, just to try and pre-qualify, so that when they do call you, they've got their ducks in a row. But when it comes to rates, let's just say over the last 2 weeks, high level, what have you seen in terms of rates, and how is that impacting people?
Okay, so here's what I'll tell you. Rates contrary to what people believe, because they've been seeing the Bank of Canada is dropping. The Bank of Canada is dropping because there is an economic crisis. I'm going to use the words recession. I will not say the words depression, but if U.S. unemployment goes to 30%, that's worse than the last depression in terms of things. Now, I think we're going to be quicker to fix it. So the common misconception is Bank of Canada goes to zero. Am I borrowing my mortgage money or interest at zero? And the answer is a very fast no. In fact, over the last 2 weeks, interest rates have been rising. While you have an economic crunch on one side, we have what's called a liquidity crisis on the other. Banks don't lend their own money, Nathan. Banks get money from a variety of different sources that they're going to turn around and lend to our clients, and then mortgages are bought and sold as investments. There's not a lot of money right now. There's a couple $1 trillion lost in the stock market. The cost of money has gone up. Hence, rates have actually gone the other way. So I've seen no less than 35 rate sheets, maybe 50 rate sheets. There's 35 different banks, but in the last 2 weeks, I'm getting 4, 5, 6, 7, 8 a day with these changes. Is money still reasonable? Absolutely. We still have high ratio money under 3%, but your interest rate where you could have refinanced, for example, with one particular major financial institution, I'm going to try to leave the names of the banks out. One particular institution for 2.54% 2.5 weeks ago, that same refinance for the same client today would be 3.19%. It's a significant amount of money, but money is still relatively inexpensive. I always say, interest rate is not the whole thing. If it's rate is rate, and that's why when we talk to our clients, we try to determine the whole thing. Rate's one piece of the pie. But that's a great conversation for us, of course, that hopefully we'll have at another time. But in terms of today's economics, COVID-19, the liquidity crisis, the sliding into recession and unemployment is driving rates up a little bit. Not enough to scare anybody, because we still have that stress test that's been around for a while, although that number has gone down a little bit to help people qualify for a little bit more. And there will be a further change to the stress test on April the 6th. So it's just keep the questions coming, and as we talk to people, we will update them on these different things.
Fantastic. How are you about kind of wrapping things up a little bit here today? This has been fantastic, by the way, but I think we've set ourselves up for a very nice segue for another conversation if you're up for it. And the topic naturally lends itself to how important is rate. Like you said, it's only one piece, one cog on the big wheel, so to speak. And are you comfortable? Maybe we can go through maybe an illustration just to demonstrate to Mr. and Mrs. Consumer, if we're looking at interest rates, maybe there's a difference of 10 basis points. How much does that actually impact them? And we'll just run through maybe a real basic scenario, but to put it into context, because these are not conversations that Mr. and Mrs. Seller have on a frequent basis. It's years in between quite often, yet you have them every single day.
Let me give you a very specific example, because I took the liberty of calling up some numbers. So I'm going to use an example of $300,000 with two different interest rates so you can see what the difference is. Because again, if the interest rate is going to be one piece of this pie, what are the other pieces of the pie? And this is where we start talking about prepayment privileges, when we talk about penalties, and that will segue into, but here's a real simple number. A $300,000 mortgage, let's say the rate is 2.89%. 25 years, I'm just using a monthly payment so we can compare apples to apples. That payment, Nathan, is going to be $1,402.86 a month.
Okay.
If we actually get it for 2.79, so this 0.1% difference,
okay,
the difference, Nathan, is $15.25 a month. So on a biweekly, we're talking about 50 cents a day. Not the 50. I don't want to minimize what the value of 50 cents a day is, but let's say, for example, the 2.79 comes with a clause that doesn't allow you to refinance your house, or if it comes with a particular, and I will say, like the regular Schedule A banks, the mainstream banks, their penalties, the way that they're calculated, are 4 to 6 times higher than with a mortgage bank. So does $15 times a full 5 years, the $915 could represent a difference of $10,000 in mortgage penalty, especially in the times of economic uncertainty. People may have to sell. We have to look at the whole thing, but this is my passion, and I can go on and on and on and on and on. But I think that I'll leave that to your call when you want to have this conversation, because we can definitely have a very passionate conversation about why this as opposed to this, or why that as opposed to that. And it'll absolutely be done without slandering any of our broker or any of our lender partners. So
absolutely, I have no doubt. And if you're up for that, I will most definitely
100%
take you up on that, and we can share some screens, maybe run some spreadsheet scenarios so people can become a little bit more intimate with the numbers and so on. And
yep.
I've kind of done my best to preach that to my clients. When they're in those early approval stages, I know that people become married to the numbers, and I'm a huge advocate of marry the principal, not the number, right? So there's something to be said for that. When we talk about the rates, it's only a small piece. We have to qualify a little bit further. Well, tell me, Mr. and Mrs. Buyer, what are your plans? Potential plans. We wouldn't be doing our job if we didn't ask these appropriate questions in the early times, because those phone calls 2-3 years from now, like you said, if they do need to sell, they can be extremely awkward when you're talking about potentially thousands, if not tens of thousands.
Correct.
In penalties. So why don't we defer that conversation to another Wonderful. One? But have I covered off everything? Just again, this is just an opener. It's just a teaser almost in this opening conversation here.
I think you have. I think what I would say as a broker is I wish everybody out there, to your viewers, I wish everybody the best health and happiness. And I may not be your mortgage person yet. I may not be that person, but if you have a question and you're having trouble getting through to a bank branch, I'm more than happy to be the sounding board. As an educator like you are over the years in this particular business, I want people to know they can reach out to me, they can email me, they can email you, and you can forward the questions. You're not alone. We're here to help.
That's fantastic. All right, David. With that, I'm going to sign off now, and thank you once again. Have yourselves a great day here, folks, and ta-ta for now.